Get started. So today, a couple things. First, today will be the end of the first half of the Bloomberg trading competition for Section 301. Here are the results as they stand right now. And this is what? Oh, you're 201? Well, put it this way, you don't want to be in 301 because it's really ugly. But let's see how 201's doing. All right, still ugly. So as a class, you guys have lost 6%. So the winning team right now is actually only down 5%. But basically, it's been a really rough 45 days in the marketplace. I think that's reflective of all of your performance. So again, you don't have to do anything by the end of today. You'll just take a screenshot and you'll continue on with the same portfolios for the second half of the semester. But nonetheless, I'll take a screenshot today around 4:45 after the market's close. I'll post it, and that would be the rankings. But if we had closed it right now, who's the A. Cohen team? Are they in here? Just by show of hands, who's on the A. Cohen team? Congratulations. Right now, you'd be in first place. You'd get 5 points, right, if we were to trade. And given your lead, I think there's a good chance you'll probably still be in first place at the end of the day. But nonetheless, it would go Cohen would get 5, Horowitz 4, Brady and Toron 3, Zhao 2, McCresh 1. That's the way the distribution would go if we were to end right now. And obviously, a few things could change by the end of today. Probably the closest, I would say, is between Toron and Zhao. But who knows? And also between Horowitz and Brady. But you can see some change at the top as well. All right, so continuing on. Second thing we want to talk today is about multiples. So two things. One, there's the next lecture note, which is available, lecture 6. You might want to have that available. And also for homework 8 and for the midterm, I put up a file in Elms called multipleanalysis.xlsx. You probably want to download that file and have it available, because that's what we're going to cover in class today as a working example. And you're going to use the exact same file to do homework 8 on Monday. And this will also be part of your midterm next Wednesday. Okay. So again, today we're going to talk about multiples. So while you're pulling that up, let's kind of give a couple of highlights. So first, start up with the concept of multiples, or also known as comparables. And I want to kind of start here on these 6 multiples. So this semester, I'm going to hold you sort of responsible for understanding 6 overall multiples. Price to earnings multiple, called PE. PEG, which is PE divided by growth, earnings growth. Enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT, and the price to book multiple. So those are the 6 multiples. Now the key to the multiples is, because we're concerned with valuation. Valuation is more based on future earnings and cash flows, not historical earnings and cash flows. So the same will apply to multiples. I care much more about the future multiple, FY2, than I do about last year or trailing 12-month multiples. Okay, so forward multiples are what we're going to be using in this class. So let's just talk about multiples are based on key value drivers. I like to say that if ROIC is a proxy for free cash flow, then multiples are just a proxy for free cash flow valuation. All right? It is really based on just an alternative way of doing DCF with rearranged math. They shouldn't give you a different answer. They should just give you a different way of getting to the answer. And it's really more of what I call the shortcut. So I'd say there's 2 reasons in the real world why people like multiples. The first, it's simple. It's very hard to do a DCF. It's much easier to do a multiple. And people like the path of least resistance. The second is people like multiples because multiples are more defensible, right? I'll just give you a simple example. Let's say you work for an investment bank, you're doing an acquisition, or you're doing an IPO, and you completely screwed up, and now you're being sued, okay? And you're the analyst that's being put on the witness stand by the hostile lawyer that's suing your company over the wrong valuation that they say that you did. So think about the answer to the question of how'd you come up with the valuation? Option 1, I did a complicated spreadsheet where I made 6 different assumptions to come up with the right price for the valuation, and a couple of my assumptions were not the right assumptions. So hold me harmless. I didn't really screw up. Or would you rather explain, I looked at the actual trading multiples in the day of the valuation, and I priced the company based on what other things are being priced on that day. Like, if you just think about it, which one is more defensible, right? Even though theoretically they should give you the same answer. So what I'm telling you is in the real world, Wall Street likes multiples for that reason. They're defensible. I can at least say I might be wrong, but I based it on something that was observed in the real world, as opposed to I'm wrong and I just made a mistake in my assumptions. So that's why multiples are often preferred. But that being said, what I'm telling you is it's an and. Like, we're going to triangulate. We're going to do both approaches because they essentially have to tell us the same answer. We're just coming about it in both directions. So we're going to look at the market to infer some assumptions. We've already done that with our G's. And we're going to basically look at our model to tell us what multiples should also be. So what does that practically mean? So here's slide 10. And in slide 10, basically this is the key value driver formula. And if you take the key value driver formula and plug in at a specific NOPLAT of 100 and a specific WACC of 10%, then basically at this level of growth and this level of ROIC, you can fill out that table. Okay? And oh, by the way, if you take that value and divide by 100, you get that multiple of EBIT. Right? So the first thing is multiples are an expression of growth and spread. Right? It's growth, ROIC, and WACC. That's actually what they are. Right? And more importantly, if the WACCs are similar, then really it's the growth and ROIC that explain the major differences in multiples. So here's the idea. Okay? So this is my NPV. Right? And NPV, the key value drivers formula divided by earnings, is the multiple of EBIT. So here's the idea. Take a company that's trading at 7 times EV to EBIT. So look at this table down here, and this is where I see a 7, this is where I see a 7, and somewhere here's a 7. So I can almost draw a line that this would be the range that would explain of growth and ROIC that get me 7 times EV to EBIT at this cost of capital. And let's assume we have another company that's trading at a 6 times EV to EBIT. So where would I find my 6s? Here would be a 6, and to some degree here would be a 6. So somewhere in here would be the line of the EV to EBIT for 6 times multiple. And so the point I want to make is, since a multiple can actually have a range of growth and ROICs that get you the same answer, I can't tell you by looking at the multiple the exact growth or exact ROIC of these two companies. But think about it this way. What can I at least assume about these two peers with similar cost of capital if one is trading at 7 times EBIT and the other is trading at 6? Looking at this table, what could I assume? Reasonably correct. 7 versus 6. What explains the 7 versus 6 looking at this table? What's the major difference? Yeah, not only higher ROIC, but positive spread. Like the company that's trading at a 7 times multiple likely has a positive spread. And the company that is trading at a 6 times multiple likely has a negative spread. All right? And so that's an example of what I mean by multiple analysis. So it may not give me an absolute number, but by understanding the components, it helps me start to get a better understanding of the things that would lead to the range that would explain the differences in the multiples. And that's part of what we're about to do. We do multiple analysis. So continuing on. The first multiple we're going to look at is PE, traditional price to earnings ratio. Price per share divided by earnings per share. Okay? So here's the thing. If we use the key value driver formula, we can actually estimate a PE. And here's how we do it. What we do is we take our formula, and instead of doing expected NOPLAT, we switch NOPLAT for net income, because PE is based on EPS, which is the cash flow to the shareholders. Instead of growth in the free cash flow, we look at the growth in net income, because it's the growth in the equity income, the cash flow to the shareholders. Instead of the return on the invested capital, which is the return to the debt and equity, we're just looking at the return to the shareholders. Therefore, return on equity replaces ROIC in our key value driver formula. And when we discount this, instead of discounting at the WACC, which is the discount rate for the debt and equity combined, we're just going to discount it at a cost of equity. So basically, we can use the exact same key value driver formula to do a clean PE multiple. Okay, that's what we have here. So playing this out, if I were to take this formula and run through a series of 4 numbers, so $100 of income, 10% cost of equity, different growths in income, different ROEs, this would be my table of results. And so same idea. If this is the value, and that's the earnings, price divided by earnings, these would be my PE multiples. Okay? And so that's the key, that we can do the same analysis when we do a PE as we can in EV to EBIT. All we're doing is just changing the inputs. By the way, I can also do what's called a price to book multiple. And if I divide the price per share divided by the book value per share, then I get this table. By the way, all this column is ones. These are all price to books of ones, which basically says the book value of equity equals the market value of the equity. Price equals book. Price to book of 1. Right? What's causing the price to books to be 1 in this column? Why are these price to books 1? Yeah.
Neutral spread.
Exactly. Neutral spread. So that's the point. What causes a price to book to be above 1? You got to have a positive spread. What causes a price to book below 1? Negative spread. Here's the beauty of the price to book multiple. The price to book multiple is a clean view of a company spread. All right. If you have a price to book multiple of 1, you have a neutral or 0 spread. If you have a positive price to book multiple more than 1, that means you have a positive spread. If you have a price to book multiple less than 1, it means you have a negative spread. So again, back to multiple analysis, I like price to books because they're a clean interpretation of a company spread. Right? But here's the problem. In the real world, price to book is the dirtiest of the multiples. It's unclean. And here's what I mean by that. It's the price per share divided by the book value of equity per share. And distortions can occur with book value of equity. All right? So I work with a company called Lockheed Martin. Lockheed, predecessor of Lockheed Martin, has been around since the 1940s. And they were a company that has pension employees for a long time. All right? And so basically, as a very old company with pension employees, what they did is they took the employees' money and they put them to work, and they called them pension assets. And they promised them guaranteed income at retirement, pension liability. And generally, a company wants to have pension assets which equal their pension liabilities so they can afford to pay their employees over time. So they invest these pension assets in the marketplace. So here's the problem. 10 years ago, there was a financial crisis. And stock prices went down about 60%, which meant that Lockheed Martin, which had invested their pension assets in the stock market, saw the pension assets plummet. So how do you, just take the balance sheet approach, if the pension assets go down by, let's say, 60%, how do I get my balance sheet to balance? What do I do? What's the balance on the other side that keeps the balance sheet in balance? Pension assets down by 60%, what's the corresponding account? Let's get a balance of. No, I don't change the pension liabilities. I still owe you what I promised you. Equity. I wipe out my equity. So I wipe out retained earnings, wipe out equity, keep my balance sheet in balance. That's accounting 101. But here's the deal. 10 years later, 2008 to 2018, the market has more than recovered, and those pension assets are now worth a whole lot more money. So the value of those pension assets has skyrocketed. However, book value accounting, we can't mark it up. See, unless you're a financial services firm, you're not allowed to mark to market the value of your assets. So on Lockheed Martin's books, they still have pension assets with 2008 values. But the real value of their assets is far higher in the real world because the market value is not reflected on the balance sheet because accountants don't let it do it. That's going to completely distort their price to book multiple. Here's the other thing. It's called contra accounts, which come from purchases of stock. When you buy back your stock, you put it into something called treasury stock. Treasury stock is a contra to equity. But treasury stock is done at market value versus book value of equity. So if you're doing well as a company, it doesn't take much of market value repurchases to wipe out the book value of your equity. So the other thing Lockheed's been doing is they've been buying back a lot of stock. So here's the thing. They have virtually no equity. So why do I want to give you this example? This is the problem with price to book. LMT, US equity. Here is, and I'll do this on the RV screen. Here is their price to book multiple today for Lockheed Martin. custom multiples $95. The market value of Lockheed Martin is 95 times the book value of Lockheed Martin. It's not 1, it's not 2, it's not 3, it's 95. And the reason why you get this crazy number is for what I just said. Because they got all these pension assets that have virtually no worth, that the market has picked up on, that the accountants don't let them write up. And they wiped out their equity by buying back all their stock. So on a book value basis, it looks like they have no equity. So this is what I'm saying is both the benefit and the challenge of multiples simultaneously. Is the benefit is price to book is all about spread. But price to book is also very distortable because it's based on equity, and specifically accounting rule equity, right? So I'm not saying we don't use it as a multiple, but we got to be careful because sometimes price to book can tell you a lot. Sometimes price to book could actually tell you very little, right? And that's the problem with Lockheed Martin. You can't just look at this number and really tell you what's going on Lockheed Martin against the peers because it's been distorted, right? Some industries you can, some industries you can't. By the way, that's actually one of the other problems with PE. Is PE, price to earnings multiples, in the real world is based on net income. And net income is subject to accounting distortions. That is why in this class, we prefer enterprise value multiples. Not saying we don't do a PE, but enterprise value multiples can be distorted, but they're based on EBIT, or more close to operating income, which is less distorted accounting-wise than net income because it doesn't have changes in interest, tax, or non-operating items. So it's typically perceived to be a cleaner multiple. Not saying we don't use PE, but PE is more distortable. And it has more factors that influence it, so it's just harder to explain. But regardless, we're still going to look at PEs. That's also why PEGs are problems too. Because PEG, which is how fast you're growing in earnings relative to your PE, is also distorted by the PE as well. So if you have a distorted PE when you do your PEG, then the PEG can be misleading. If you have a clean PE when you do your PEG, then PE can tell you how valuable your growth is. And it can be a very valuable ratio. So again, I just want you to understand that because we're using shortcuts, and I'm not saying we don't do them in the real world, we're going to be careful because every now and then the rules kind of get in the way of truly understanding what the multiples are telling us. And that's just more sophisticated, but I wanted you to be aware. But that's why we're going to start with EVs. Yes?
So you said financial services firms are allowed to mark to market their assets?
Correct. So if I'm a bank or a investment firm like a BlackRock, I can mark to market the value of my balance sheet every day.
That's why price to book is more commonplace.
Correct. Yeah. But there's still distortions in some of that accounting because they can actually say these assets are not for sale and are going to be held long term by the bank, and I don't mark those to market. So there are games that banks can play depending on how they classify their quote-unquote inventory of investments. And so I can actually put some of my mark-to-market investments into a category that I don't mark-to-market every day, and then that is a game that banks will play. So I'm just telling you, every one of the things has games. And that's the problem with accounting, is that I can play my games. I just got to be aware that that can distort what I look. But generally, banks are better just because they can mark-to-market. And that's why price to book is more clean for most banks. Absolutely. Yes.
How transparent are they regulated to be?
I
If you
mean,
were reading a 10K, would you be able to find out how they do their accounting? Or
yes, it's somewhat disclosed. And what they'll do is if you look for a bank as an example, I forgot the exact terms they'll use, but they'll say, here is our investments, and they have three categories. I forgot what they're called, but one's like available for sale, and then the other's like held for long-term investments, and there's a third category. But some of them are mark-to-market and some of them aren't. Now, they won't disclose in the 10K which ones are mark-to-market, but nonetheless, you have to know the accounting rules to know the differences and how they're valued. Okay? So that's why the notes can be very important. But regardless, that's not the point of our conversation today. Here's what the conversation today. So I want to start with this spreadsheet that I gave you, which was something we did last semester for Procter & Gamble, for Clorox and Estee Lauder for multiple analysis that we're going to repeat. And in the interest of time, I'm giving you this spreadsheet today to help you with homework 8 and future assignments this semester. So this is basically two tabs. The first tab is the price to earnings multiple. This basically is a process that we've already done. And the whole key to this process is using observed data in the real world, we can estimate a G for the growth in net income that basically explains the real world PEs. All right, so similar to the process we've done in our valuation models. So let me show you how we would use this spreadsheet. Start out with Procter & Gamble. So I'll go to PG, US Equity. I'm going to start out with the EEO screen. And on the earnings estimate screen, again, multiples are based on future cash flows, the ones we care about. Therefore, forward year 2 is what we've been using this semester. So for forward year 2 for Procter & Gamble, what is their forward year 2? What year is that? 2020. Okay. So first thing I need for 2020 is using key value drivers. I would need their 2020 expected net income. And what I care about is called the adjusted net income, because this is where the accountants or the analysts can take out accounting adjustments. So technically it's a cleaner net income. Anyways, that is expected to be 12,027. 12,027,000,000. Okay. Now, if I scroll down or make it smaller, here is the forecast for return on equity for the next 3 years of Procter & Gamble. So I'm going to take an average of the 3 and say that's representative. So right now, 2019 return on equity, 20.5%. 2020 return on equity, expected to be 22.3%. And 2021 return on equity is expected to be 25.3%. So if I took those 3 numbers and divided by 3, 22.7% is the return on equity for the next 3 years. I'm assuming that's representative of their future, but what I really want is a representative ROE. All right. Next, I need a cost of equity. I'm going to get the cost of equity off the weighted average cost of capital screen. And the cost of equity, since I'm discounting equity cash flows, net income, it's not the WACC, it's the equity cost, which is 8.3%. So this is 8.3. All right. And finally, my observed PE in the marketplace is also on the EEO screen. For forward year 2, 2020, adjusted PE based on adjusted EPS, which is the same as net income, is right now 19.18. Okay, so here's the deal. What G gets these two to match? 4%. Hey, I got lucky. 4% basically gets these two to match. Similar process. All right, let's treat this for Clorox and Estee. So let's go to Clorox, CLX. And let's get some numbers right off the screen. So for 2020, second forward year, net income, $847 million. Price to earnings multiple, 22.54. And expected return on equity, 208.5%. So we'll call this ridiculous return on equity equals left paren, so 208.5, so 2.09 plus 521%, 5.21. You want to talk about distortions by buying back all your stock and having almost no equity left. There you go. And 426% plus 4.26 divided by 3 is 385% is their average return on equity for the next 3 years. Right? Oh, by the way, their WACC, cost of equity, right now is, for Clorox, 8.1%. Okay, not the WACC, but the cost of equity. All right, while I'm on the screen, I'm going to do Estee, so Estee Lauder. Their cost of equity is 9.4% right now. The other 3 variables I get off of EEO. Okay, 1-2 forward year. Net income adjusted, 1955. Go ahead and put their PE here is 2386. Is that right? And then finally, their expected return on equity is average of the three, 36.2. Plus 40.2 plus 43. So basically about 39.8% going forward. So if I tried to solve for the G's in net income for Clorox, start at about 4%, 3.8, 3.7, getting pretty close. How about Estee, 5, 6, 5.7, 5.8, and 8.2, something like that. Pretty close. Okay, so that's just the math. That's the math, just similar to the process we did in our valuation models to back solve for G's based on market data and using the academic formula to understand the components of return of the price earnings multiple. Key value drivers, what really drives the multiples, these things, growth and spread. So here is the question. Discount means the multiple's lower than your peer. Premium means you're trading at a higher multiple than your peer. So here's the question. Why is Procter & Gamble trading at a discount in their multiple to Clorox? Why is Clorox at 22.5 times earnings and Procter & Gamble at 19.2 times earnings? Why is Procter & Gamble at a discount? Think of this not only as your homework 8, but also midterm 2 question. What would you say? Here's your data. Why? Using that data, why is Procter & Gamble trading at a discount? Yeah.
They have a lower expected ROE.
Yeah. And if you look at it, it's a higher growth. So the higher growth should actually help them in this case. They have a slightly higher cost of equity, which should hurt them, but it's really our ROE. And that's the point, is that Clorox is trading at a much higher value than Procter & Gamble because of that higher return on equity. And it's very clear when you look at the multiple data. Everybody with me? Okay. Now, Estee Lauder. Why is Estee Lauder trading at a premium to Clorox? So we know why Clorox is more valuable than Procter on a multiple basis. Why is Estee trading at a premium to Clorox? Somebody else. Go ahead. One, it's a higher growth, but it's much higher growth at a lower spread. So the first thing is the growth rate is, and again, you got to use numbers when you do this, 5.82% versus 3.7%. If I grow 6% forever and you grow 4% forever, you're going to be worth less forever. So that's the point. These are perpetuity numbers. So the growth is definitely helping Estee. However, it's growth at a lower spread, and that's the point. If I make 40%, grow that at 6% a year, and you make 385%, grow at 4% a year, eventually I'm going to catch up and pass you. And that's what we're seeing in the marketplace. That's why Estee is a little bit of a premium to Clorox. However, it is being hurt by this higher discount rate. So this is the important nuance I want you to add to your thinking that we hadn't talked about before. Because before we just said, if you had a better spread, then more growth with better spread equals more value. But we're dealing with DCF. We're dealing with discounted cash flows. 9.4% is our discount factor. 8.1% is our discount factor. If I discount your cash flows at 9.4 versus 8.1, those cash flows are worth a lot less. So the one thing that's hurting Estee, which is why their multiple's not much higher with that high growth rate, is because it's being offset by the much higher cost of equity. And I'll give you what I mean by this. If Estee Lauder's cost of equity equals Clorox, then their multiple would be at 37 times earnings. So this growth would be a huge accelerant, but it's got a headwind of the additional risk. Because there's a lot more uncertainty about Estee's business, high-end luxury cosmetics, than there is Clorox selling bleach. And so that's the point, is that something that's actually hurting the multiple of Estee, not hurting as it's lower, but not making as high as it could be, is the perceived risk of their stock. And that's what we would understand by doing this multiple analysis. Questions? Could you repeat this? Because this is your homework assignment for Monday. Do you know where you got all the data from? And do you know how I'm making these conclusions? Yes?
What is the spread here?
What is the spread? It's between ROE and cost of equity. The difference between the two is the spread.
How does EL have a higher spread?
EL has a lower spread. Clorox spread is 385 minus 8, and this is 39.8 minus 9. So Estee, EL is Estee Lauder. They have a lower spread.
I thought that was
No, this is a higher spread. This should be the premium. But what I'm saying is it's spread and growth. It's this growth rate compounded to infinity, which is what a perpetuity is, which is really this spread, which is actually a great spread, growing at 6% a year, CAGR, is better than this spread growing at a 3.7% CAGR. That's why in the real world, Google is almost as valuable as Apple, because even though we talked about this earlier this semester, Apple has an absurd return, Apple's not growing. Google's still growing very rapidly. It's playing out here with Estee and Clorox. But it's not playing out as much as it could because Estee, despite the spread, has a higher absolute discount rate. And so one of the assumptions we made in all of our analysis to this point this semester is the discount rates were similar. But what I'm telling you is that the discount rates, think wax and cost of equity, are not similar, then that could actually distort things a little bit more than you think. Because even if you have a similar spread, if my spread is the same as yours, but my WACC is 8 and yours is 10, then the company with the 8 is going to be much better, even with the exact same spread, because I'm not discounting them at as high a rate. Okay, let's continue on. Second tab are the enterprise value to EBIT and sales ratios. These are the other two enterprise value multiples. So let's come back to the PowerPoint. So the good news is you've already done this one. This is what we did last week when we took our Boeing and then Coke valuation models and we basically estimated G's. So we actually use this formula to estimate a G already. And that's the point. If you start with the key value driver formula and you rearrange the math, you get to your enterprise value to EBIT multiple. So that is what we're going to do here. By the way, the other thing we're going to do is if you start with this formula, and you rearrange it, you get to your enterprise value to sales multiple, enterprise value to revenue. And so basically what you do is you take this, divide both sides by, NOPAT is revenue times EBIT times 1 minus tax rate over revenue, divide both sides by revenue, and you basically get your EBIT times 1 minus the tax rate times that divided by that, because this is going to cancel out to be enterprise value to sales or enterprise value to revenue. And here's the thing, this is EV to EBIT. So enterprise value to revenue or enterprise value to sales equals pre-tax EBIT margin times enterprise value to EBIT. So therefore, if you take your EV to revenue divided by EV to EBIT, you actually get an estimate of your pre-tax margin. So sitting in plain sight is the perpetuity EBIT margin of a company. So one of the things that we did in our models, we've been guessing it. I'm telling you that the market is already forecasting margins. And we're going to use this to then tease out the margins. So that's just kind of the academic side. Let's come back to our Procter & Gamble, Clorox, Estee example. So first thing we need is we need a tax rate. Where do we get the tax rate in Bloomberg for Procter & Gamble? Where was our preferred method? Where do we go? EVT. Now, my shortcut to EVT that you don't have is TA. But this text analyzer, transcript analyzer, lets me search the EVT screen. And if I do it for a single company, and I just look for tax rate, then for Procter & Gamble, blah, 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 they're saying that our annual tax rate is going to be 21% is the number they had there. And they said here, tax rate guidance between 19 and 20. So I'm going to use 19.5. I'll take the midpoint of their guidance for the tax rate. Since I'm on the screen, let's look up Clorox, CLX, TA, again, look up tax rate. For Clorox, they're basically saying between 23 and 24. So again, 23.5. And for Estee, they're saying their tax rate I think they're guiding to 22. So let's use 22. Looks like it. So here's the next thing. I'm going to solve for my G's. We're already doing this in the models, the same formula. I now need my expected ROIC. Here's where homework 5 can help you. For Procter & Gamble, right to P&G. If I go to the RV screen, RV, and if I go to homework 5, under custom, we put in a formula to estimate operating ROIC. That was a custom field in Bloomberg that you did in homework 5. So another reason I had you do it is because we need an operating ROIC to do the multiples. Now, the assumption we're making here is that this operating ROIC of 16.7% is indicative of the future one. If I don't think it's the one for the future, I need to change it. So one of the ways I can be more granular is I could actually have done the valuation model for Procter & Gamble, looked at my forecasted ROICs to try and see if that was dramatically different. But let's assume it's not, so let's start with 16.7. Let's say that that is representative, 16.7. By the way, since we're on the screen, Clorox, 30.6. And Estee, operating ROIC, if we use that to be representative, last year representative, 26.62. So 26.6. All right, wax. Estee's WAC right now, 8.9. Clorox's WAC, 7.5. And Procter & Gamble's WAC, 7.7. The observed EV to EBIT multiple is off the EEO screen. On the EEO screen, fiscal forward year 2, 1/2/2020, EV to EBIT 16.23 is P&G. And the EV to sales, EV to revenue, right now is 3.59. That means for every dollar of sales, they have $3.59 of value. Okay? So back to this. Our estimated margin is EV to sales divided by EV to EBIT. The market is expecting their operating profit margin, EBIT margin, to be 22%. Based on those trading multiples right now. Why is that important? Mixing metaphors. If we go back to our Boeing valuation, what is the operating income of Boeing in perpetuity? That number is that number. I know it's Procter & Gamble and Boeing. But what I'm saying is the final part after we get back from the midterm is on Monday, I was struggling with Coca-Cola to say, all right, to get to the share price, do I lower the growth or do I lower the margin? And I was trying to figure out which one I needed to lower, and I ended up lowering both. Using the multiples, I know what the margin is. So then I can back into the sales. So that's the other thing. Just as we backed into a G, we can back into an estimated EBIT margin, and therefore an EBITDA margin. But that's for later. So let's continue on. And by the way, just make sure I carry this forward as a formula. So let's finish off with Clorox. So for Clorox, again, EV to EBIT is 2020 is 18.21. And EV to sales is 3.42. And for Estee, EV to EBIT is 2020 is 17.9. And EV to sales is 3.1. All right, so G's. 4%, 3.9, 4%, 3.8, 3.82, we'll call it. And for Estee, 5, 6, 5, 7, 5. Close enough. All right, so that's my solve for G's. They get the models to work. And oh, by the way, make it a little bit smaller. If that's my margin and that's my ROIC, that has to be my productivity. So if you go back to the ROIC tree, margin times productivity equals pre-tax ROIC. So there's my ROIC. There is my productivity. Now here's the thing. I need the after-tax to do an after-tax ROIC. So therefore, this is my pre-tax margin. This is my after-tax margin, my new plat margin. This is my after-tax ROIC. So I back out my productivity. So here's the other thing I know, is that to generate $1 of sales, Procter & Gamble in the future is expected to have to invest $1.07 of investment. To generate $1 of sales in the future, Clorox is closer to 50 cents. Which one is more productive, Clorox or Procter & Gamble? Clorox. They're using half the investment to generate the same amount of sales. And by the way, that isn't what I put in my model. That's what the market is telling me that they're expecting based on the trading multiples. See, that's what I'm saying is we're getting all this data without ever doing a DCF, right? Because we know that the DCF is just rearranged math, and using the rearranged math, we have to back out to what these assumptions have to be to make these multiples make sense, right? So I have a sense of what the margins are going forward. I have a sense of the productivity going forward, and I have a sense of the key value drivers going forward for these three companies based on those multiples. So let's ask the question again. Why is Clorox trading at a premium to Procter & Gamble EV to EBIT? So why? Go ahead. All right, so be more specific.
Well, Clorox is giving the same returns of 50% cost.
Yeah, so I'm saying when I say be more specific, 0.47 divided versus 1.07. Use numbers. You got to use numbers. But more importantly, that productivity means that Clorox gets a higher ROIC than Procter & Gamble, even though Procter & Gamble has much higher margins than Clorox. So even though Procter & Gamble has much higher margins perceived in the future than Clorox, they don't have the ROIC because, as you just pointed out, they're spending a lot more, $1.07, to generate those sales, where Clorox is only spending 47 cents. And that means that lower ROIC, lower spread for a similar WACC, and similar growth leads to lower multiple. So for them, it's all the lower ROIC. And more importantly, what's driving the lower ROIC is the productivity. That's what I could say about Procter & Gamble relative to Clorox. Why is Estee trading at a discount to Clorox? Because Estee is now at a discount in enterprise value multiples to Clorox. Why is Estee trading at a discount right now? And I'm talking about these multiples. Estee is at 17.9, Clorox is 18.2. What's happening with Estee? Because you would assume with a higher growth rate, 5.43 versus 3.8, that was really helping their PE. That should help with a higher spread. What's the challenge that Estee's having? Because they have a similar tax rate. Their tax rate should actually help them. They got a 22% tax rate versus 23.5. So lower taxes, higher growth. Why is this multiple lower? Yeah.
Because their WACC is 8.9 compared to 7.5.
It's less about the slightly higher spread and more about the WACC. And this is where, as I said, two companies with relatively similar spreads, but the WACC being higher is what's killing Estee in its multiple. So let me say this another way. If this was 7.5, their stock price would be dramatically higher and they'd have a EV to EBIT close to 30. But it's not, because they have a higher WACC. This is what I mean by even though the spreads look somewhat similar, because they have the higher discount rate, it does affect the valuation. That's what we're clearly seeing here. So it's really hurting, and to some degree, I guess, I use the word muffling. What's muffling P&G is their WACC. Questions? Yes?
Is it a lower multiple? Because it's trading closer to the
Well, I wouldn't say a lower or higher is necessarily good or bad, but here's what I'm telling you as an investor. I would like for my company to basically, people pay as much for that company as possible. So therefore, to pay more for my earnings, pay more for my sales. What's going to be you to see the value to pay more is that the underlying economics have to be more favorable. So the way I kind of look at it is, if you have a lower multiple, then your underlying economics, growth and spread, aren't as attractive. So it's not a question of better or worse, because what I care about is what it's going to change over time. But the assumption is, if I do have a better spread and a better growth, that multiple suggests that it'll change at a faster, higher rate over time. All right, so that's the point. I mean, if you play the practical side of this, every time Estee Lauder gets $1 of earnings in net income, that should generate $24 a stock price. Every time Procter & Gamble gets $1 of earnings, that's to generate $19 a stock price. So from an investor standpoint, I like going up $24 every time I get a new dollar of earnings than $19. That's the practical way people would interpret that. Yes?
How do you find the balance between what you just said and then using PE to figure out if the stock is undervalued?
Well, again, what causes the stock to be over or undervalued is not the absolute PE, because if these numbers come out true for, and I'll go back to PE, for Procter & Gamble, then they're appropriately valued. Because the academic formulas say with these numbers, this should be their value. So here's what we mean by over or undervalued. If I really thought that P&G could grow at 5% and the market thought it could grow at 4%, well, guess what? I buy P&G because I'm getting something that's at a discount right now. That's the idea of overvalued, undervalued. But the idea to make it over or undervalued is I want to know that this is a fair price based on these assumptions. So it's not a question of over or undervalued, it's actually fairly valued based on those assumptions. So the overvalued, undervalued comes from whether or not I think those assumptions are right. But then that's the other part about comparisons. What makes this company pay more for this company than that company? Well, it's exactly the same thing. They're at 4, they're almost at 6. I'd rather have 6% growth than 4% growth, but I got to pay for that. I'd rather make 40% every time they sell something versus 22.7% every time they sell something, but I got to pay for that. But there's more risk here. And so I don't pay that much more because the risk is greater, but I still pay more. That's what we're seeing when we do the multiple analysis. But good question. Other questions? Because this is what you're going to have to repeat, as I said, on Monday and on the midterm. Monday, you do the math yourself. Midterm, I might give you the answers, but you're still going to have to come up with the conclusions. And again, reference numbers. Don't just say P&G is higher in something than Clorox. You got to say P&G's expected growth in income is 4, Clorox is 3.7. You got to use absolute numbers when you write stuff up. Other questions? All right. So again, here's the thing. I'll give you one more interesting thing. So let's go back. Open. Oh, where did we do this? Coke. Do I have the Coke model in here? Homework 7. All right. This was the Coke as is model that we were talking about earlier in the week. We got a G, we got a target stock price, and so this is more advanced. This is beyond your assignment on Monday, but it's a preview of how this can help us. So here's the deal. When we were doing the as is for Coke, one of the things that I was struggling with is, do I change the growth rate or do I change the EBITDA margin to get the stock prices to match? And I had to lower growth and or lower EBITDA to match the stock prices. And I was, same idea, kind of spitballing which one do I think should be done more or less. So here's the difference. If I were to take, you can see in Bloomberg, and I'll go back to Coke. EEO. This is today's EV to sales. This is their EV to EBIT. Okay? Now, here's the thing. I'll do it based on the time of our valuation last week. So this is the EEO, same screen, a week ago. So a week ago, EV to sales for Coke for second forward year, 2019, was 6.8. Equals 6.8. 6.8, which is EV to sales, divided by EV to EBIT, 2019 was 20.22. that last week had to be the number that the market was using for that sell. That's what the trading multiples told me. So when I was struggling to say, do I change growth or do I change EBIT? The market actually came up with an EV to EBIT of 33.6. So in my model, I can't change this directly. So how do I change this by 1.7%? I make this 37.2. That's the number the market was using. So if I actually put this in, or I would go middle point, 37.3, and this is what they're using in perpetuity, well, then the actual answer is that they weren't talking about 3% growth. They were probably talking about closer to 0 or even negative growth when I actually was doing the valuation. So when I was struggling, I thought the market was worried about Coke's growth and worried about their margin. What the trading multiples actually told me is what? What was the market more worried about last week for Coke and some degree right now in the next few years? It's not their margin, it's their growth rate. Like they actually really believe, based on the trading multiples, that Coke is going to see no growth in sales. So that's the point. They're going to protect their margins, but they're not going to protect their sales. And oh, by the way, all these things that they're getting into are just offsetting the declines in their sugar business. So coffee, and to some degree, whether they call it, what's the marijuana stuff or the alcohol, is just basically growing, but the sugar business is shrinking. And so even though Coke is protecting their margin, they're expecting very flat growth. So that is an additional insight by doing the multiple analysis for Coke that I didn't have on Monday. I was gut feeling it, but now I can actually back that out in the as is. So that's an additional step to the as is, because now it's no longer a question of the margin and the growth. I know the G, I know the margin, I know the tax rate, I have a good idea of the operating ROIC. I can tell you what the growth has to be. So again, another advantage of doing multiple analysis. Questions about that? We'll make this addition to our model after the midterm, but nonetheless, this is what's next. Yes?
This is a more general question
Mm-hmm.
about companies like Coke that are super mature and won't see as much growth.
Yep.
Like what happens to businesses like that?
Well, here's a data point. Since the year 2000, 50% of the Fortune 500 is gone. Since the year 2000, half the Fortune 500 is gone. So increasingly in today's world, I don't know if we have the companies today that we're going to assume they're going to be around in 30 years. Like their businesses, like we're seeing, and again, separate topic, but Rita McGrath at Columbia University calls this the wave theory. And what she says is competitive advantage is transient, which means companies are like waves. They're going to go away unless they find what's next. And so that's the point. Like Coke right now is struggling to figure out what's next. They're the company of yesterday. And if they want to be relevant to the company of tomorrow, they have to evolve. And now that sugar is perceived as bad, if they can't evolve beyond sugar, Coke's in trouble, right? I'm not saying they completely go away, but they're not going to be as successful as they were in the last 40 years for the next 40 years if they don't do something. And companies like Sears literally will be gone because they didn't figure out what the new wave is for online retail. They are truly the company of the past. GE is truly the company of the past. They haven't figured out how to be the company of the future anymore. So what I'm saying is, I think that plays out in our valuations, is that for mature companies, we have to make the question is, can these mature companies stay relevant in 20 years? And the data is against you. McKinsey's data says ROIC goes down to regression to the mean. Increasingly, people are starting to say that the lives of companies is getting shorter and shorter. And that rate that this is happening at a faster rate. So this should start influencing our idea of valuation. So back to even car companies. Can General Motors, which today there's an article about their Maven Uber service, where they're basically getting people to basically take their cars and rent them out to other people without being car rental companies for weeks at a time. But here's the point. is General Motors going to be the company that you buy your cars from in 20 years? Like, is that even the relevant business model where we produce a car and sell a car? Which is, if car ownership changes and you're just, you're basically paying for, like, you pay for cloud-based computing, you pay for usage of cars on demand, do you even buy a car? And if it's a self-driving car, is GM the people that build the self-driving cars? And if we're going away from gasoline-powered engines, are they going to be able to make that transition? I don't think it's a foregone conclusion. And that's what I'm saying, is that as you start inferring this across companies, some will thrive, some will not, but it's their Darwinian process. And so that has to overlay with the financial assumptions that we make. This is not easy, but that's part of what we need to do. All right, other questions, comments? All right, so here's the deal for Monday. Let's go back to this. Sorry, that was the other spreadsheet. You're going to basically get 3 new companies. I'll post it end of day today. I didn't post it so far because I don't want you doing it during class. But basically, you get 3 new companies, and you're going to have to basically fill it out, and then you're going to have to basically write out individually papers, which basically say, why is it a premium or discount to the other peers? And premium means trading at a higher multiple, discount trading at a lower multiple, and then referring to numbers and referring to these drivers, explain, just like we just did here in class. And we'll debrief this during Monday's class. Yes? No, you will get the numbers. For this homework assignment, I'll give you the companies. And then just like I just did it real time in class, for those 3 new companies, you'll have to go to Bloomberg, get the numbers, fill it in, and you'll submit an Excel spreadsheet and a write-up. Right? Then, for your exam next Wednesday, midterm exam, there will be an exam question that will have data similar to this. The difference is you won't have to calculate the numbers on the exam. Like on the exam, I'll give you the numbers. You just have to explain. But that'll be one of the essay questions. So I've already told you what 3 of the essay questions are in the exam. So when people were like nervous about what's going to be on the exam, can I study for it? This is one of the questions. Right? Another question is going to be the ROIC tree. A third question is going to be explain the CFI analysis. I can tell you right now, those are 3 of the 5 or 6 questions you're going to get. Right? Other questions before we end class today? All right, great. We'll see everybody Monday. And again, this is going to be due Monday, 10 a.m. for all sections. All right, and then check today about 4:45 after the next section's over for the posting of the assignment. Okay, good luck.